Hey friends, welcome back to episode 884 of the Money Girl podcast. I'm your host, Laura Adams. Today, I'm excited to be joined by a special guest and friend, Tony Steuer. He's an award-winning author, podcaster, insurance analyst, and financial preparedness advocate who is passionate about changing the way we think about money. Tony has written multiple financial books and workbooks, including Questions and Answers on Life Insurance, the Life Insurance Toolbook, and Get Ready, a step-by-step planner for maintaining your financial first aid kit. And he's the host of the Get Ready Money podcast. You can learn more at tonysteuer.com. It's TonySteuer.com. As you'll hear in today's interview, Tony has deep knowledge in insurance and finances. We talk about what should be in your financial and insurance first aid kit, how to navigate open enrollment and choose the right insurance policies, exactly who needs life and disability insurance, why getting life insurance outside of work can make sense, what disasters are never covered in standard homeowners and renters insurance, how to save money on home insurance with things like discounts, remediation, and comparison shopping. And we cover a lot more. So I won't make you wait. Here's my interview with Tony. Tony, I'm super excited to have you on the Money Girl podcast. We've known each other a long time, but I have been wanting to get you on the show and talk about insurance and disaster preparedness and all that good stuff for a while. So I appreciate you being here.
Yeah, excited to be here, Laura. I've always appreciated the way you make things understandable for people and how you make complex subjects simple. So we're completely aligned on how we approach things.
Absolutely. Yeah, you and I met quite a while ago. I was working in sort of the insurance space as a spokesperson and doing a lot of research into various types of insurance and rates and what affects rates. And so I got really deep into the insurance world. And I think you were a resource many times when we were publishing content, looking at different studies that we were doing and that sort of thing. So I'm curious how you got into insurance. How did you become such an expert in the field?
Well, like every kid, I grew up dreaming of going into the world of insurance. So,
Not.
Yeah, exactly. So, I started in insurance as a life insurance agent, which is how most people come into business. And pretty quickly, I met somebody who was a fee-based insurance consultant, and I, was really interested in how things worked, how the marketing worked and everything. So I got involved as a fee-based insurance consultant, and I discovered that even advisors, financial planners, attorneys, trust officers, that everybody had a surface level understanding of insurance, but there was a lot of misconceptions. So I started writing about insurance, which is where we met. I started doing some more written interviews at the time. I just got really into talking about it and advocating for it. I spent a little time at a nonprofit. I volunteered with the California Department of Insurance Curriculum Board. So, it's really become a passion of mine, helping people understand their insurance and the value it can provide.
Yeah, I do think on the surface it does seem like a dry topic, but when you dig into insurance, it is really broad. There's just so much that goes into protecting ourselves and protecting our finances. And whether we're talking about property or we're talking about liability or business insurance, life insurance, there's just so much to it. Most people, as you said, they just don't really have that much of an interest in it, of course, until you need it. And I always say insurance is the only product we buy that we hope we never need to use. When we have it, we're awfully glad that we have it. Of course, most of us are going to have health insurance. That's typically what I think most people are most familiar with, and car insurance, of course. Beyond that, the home insurance or the renter's insurance might just be something we have because we sort of have to have it. We don't really know what it's all about until we actually have to use it. What I'm hoping you can help us understand today is how do we protect ourselves in terms of a broad base of, as you call it, a kit. It's sort of a personal finance protection kit that we need to think about as just an individual and just kind of the basics on what should we have to protect ourselves. A lot of us have insurance gaps. We're missing some things that make us vulnerable. I'm kind of looking to you for advice on what people should know on how to fill those gaps. And so I'd say, of course, we all need health insurance, but there are probably some people listening that maybe are uninsured. So let's just talk a little bit about that. We're in open enrollment right now. So what tips can you give people if they're shopping for coverage or should be shopping for coverage either on their own or in the workplace?
I think that we need to reframe how we think about insurance is that it's really, yeah, at its base, as you mentioned, it's risk protection. Whether you get it through an insurance policy or not, you are self-insuring. So, for example, we talk about emergency funds, but that's self-insuring against a potential event. So once we start thinking about that, we can start thinking about the risks that we have. So when it comes to open enrollment, it can be pretty intimidating. I do the open enrollment for my wife. She works for a large company, so she has a pretty long list of things and coverages to go through. When you go through the things is you have to consider if it's disability insurance, health insurance, vision insurance, dental insurance, life insurance, is whether you have a need for that type of insurance, whether you need to protect against that risk, or do you want to self-insure? That's a decision that you make. So if you have something like disability insurance, and I know we're going to talk about it a little more, is if you don't buy disability insurance, you're self-insuring, which means you're protecting that risk on your own. I mean, that's why we buy health insurance, is we know that the cost of healthcare can become crazy if we have, like a heart attack or we need transplant. It can get really expensive. So when you're going through your open enrollment employee benefits, is with each coverage, look up and see what that coverage is and whether you need it or not.
That's a really good point. Whether you think about it or not, if you're denying certain coverages, you are saying, I'm self insuring. And basically, that means you better have the money in savings to pay for that risk, that vulnerability, whether it's losing your job after you get into an accident and you can't work, or, whether, like you said, you need to go into the hospital, or whether you die and, what happens to your family and your loved ones after you're gone. Those three, the health, the life, the disability, are definitely the three main ones. You might also have some additives in there, cancer insurance, kind of some specific types of medical risk that are off. People have probably heard of AFLAC. That type of coverage is sort of above and beyond your regular health plan. So people, they may have a lot of options, or you may be somebody who's self-employed and you have to create that benefits package on your own. So that's a great place to start. It's saying, what is my risk? If you keep a lot of money in savings, okay, maybe, you could weather being out of work for some time. But for most people, I think those coverages, especially through work, are pretty affordable. They typically are going to pay off because your employer is subsidizing, in many cases, a portion of that premium, right? So they can be a little less expensive when you're buying them through work with a group plan. But if you're not buying them through a group plan, you're on your own, you really do have to do a lot of shopping. And I'm in that situation. I'm self-employed. So every year, I'm really comparing policies and looking at what I need and what I don't need. But let's talk about that. How do you really make the choice in terms of specifically choosing a health plan? Should you go high deductible? Should you go, lower deductible? How do you think people should approach the actual type of policy that they choose for health coverage?
Oh boy, we could spend a whole episode on each type of coverage and still not get not get all the way there. But I think the basic rules again are to really, one is when you think about the coverage, and we'll pick health insurance, is because that's the big one. Everybody's going to get some form of health insurance when they have an employee benefits program. Usually, you can't even opt out of it. So the big question always is like, okay, what deductible do I get? Which one is the best? So you take a look and you think about what your needs are going to be. If you're someone who's 25 years old you have zero health issues, you see a doctor once a year for your annual physical, if that, and you've got a pretty clear medical history in your family, well, then you can probably get a high deductible plan because you're not going to need to access your health insurance. If you're somebody who's 55 years old, you have a couple medical issues, you're going to the doctor once a quarter or whatever, you have a lot of medications that you're taking, well, then you're probably going to want a lower deductible plan because each of those things is going to be cheaper. So with a higher deductible plan, you're going to be paying more with what's called your copayment every time you go to see your doctor. If you're going to see your doctor a lot, then you know you need a lower copay because you don't want to pay that much each time. I have a spreadsheet you can download from my website that kind of walks you through it, or you can just do it yourself and calculate out how much you think you spend each year on your medical expenses and then project how much you think you're going to spend next year. Usually it's the same for most people from year to year. And if you have a pretty high outflow, then you may want a lower deductible to help offset that. Now, finding that optimal deductible can be a little tricky, but you can still estimate your total cost. So how it would work is, real quick, just the total cost would be your premiums, the sum of your copays and deductibles. And that's your total cost. So you can play around with it and see, okay, if I take a higher deductible, I'm paying more in copays. So how much does that work out to you for the estimated number of visits? So hopefully that follows for people and gives them a good overview.
Yeah, that's great. I mean, I think, like you said, the younger, the healthier you are, we never know for sure what the future brings. It's kind of like trying to estimate, what taxes are going to be down the road. We don't know. We have to make our best guess based on our health history, maybe our family health history, and just knowing your lifestyle. Do you do a lot of risky things? Do you like to, go snowboarding and you're really, high risk type of sports person? You might need some medical care. But if you're younger and healthier, I think the higher deductible plans can make sense for most people. When we talk about life insurance in the workplace, we typically only see term life policies being offered. How should people think about choosing that, choosing an amount, and then maybe also when does it also make sense to buy coverage outside of work?
Two parts to that question is with life insurance is it should always come back to the question of, do you need life insurance? There's an impression in our society, because the life insurance industry is very good at marketing this, that everybody has a need for life insurance. And that's not necessarily true. Now, you may have a need for a small amount of insurance for your final expenses, but if you don't have anybody who's financially dependent upon you, you don't have a need for life insurance. And, the old adage is like, well, you need to buy it in case you're uninsurable later on. The same thing if you think about it this way, it's buying car insurance for a car you might buy later on at some point. You wouldn't do it until you actually have that need. With life insurance, it always comes back to, is somebody financially dependent upon you? And then in terms of the type of insurance, the question is, how long will you need the insurance coverage for? So if you're buying it, take care of your kids so that they have money to finish school, whatever, then that's a defined period. Let's say 20 years, 25 years, depending on whether you want to help them through college. That would be term insurance because it's a defined period. And that's what term insurance is. It's not temporary insurance. It's insurance that stays in force for a specific period of years. And then as to whether it's better to buy it outside the employer, if you're healthy, it's almost always better to buy it outside your employer for a couple of reasons. One is coverage through your employer is usually not portable for life insurance, which what that means is if you leave your employer, you can continue it. So if you're buying coverage for, let's say, 20 years, are you going to be at your employer for 20 years? Probably not. In today's world, most people don't stay at their employers for long periods of time. And if you're healthy, keep in mind that for your employer, they're doing more of a universal rate because they have to insure people who are less healthy and people who are healthier. So if you're super healthy in the private insurance market, you're going to get a lower premium for if you are healthy. So those are the things to start to weigh.
Yeah, that's great advice. And tell me a little bit about who you think is a good candidate just in general for permanent life insurance and what that is, just an overview.
That's an excellent question. And this is something I talk about all the time. Most people are not candidates for permanent life insurance. You don't need it unless you have a permanent need for life insurance. That's where the name permanent comes in from. Life insurance is not an investment. It has an investment component, but you can't buy it for an investment. You buy it if you have a need that's going to last foreseeably for the rest of your life. Now, let's say that could be a special needs child who you're always going to need to financially support. So that would be one need. If you're pre-funding estate taxes, that might be a permanent need. Let's say you want to make sure that there's always some liquidity. Let's say you're investing mostly in real estate. You've bought a couple apartments, you bought a couple houses. There's not a lot of liquidity in your investments. So you might buy a permanent life insurance policy so there's always some liquidity for your partner or for your kids, whoever your heirs are going to be. So that's really the question. Is there somebody who's going to be financially dependent upon you for a longer period than a term policy?
Yeah, it's great. I do think that's a real confusion for people because, like you said, life insurance companies have a lot of money. They advertise very well. They want to convince people that you need to buy life insurance as an investment. And as you said, in most cases, it does have an investment component, but it should not be thought of as an investment in the purest sense. If you buy life insurance, it needs to be because you need life insurance. So, yeah, that's great. What about disability? I think a lot of people have some choice in the workplace, whether it's short term or long term disability. What are some tips in choosing that and thinking about that inside the workplace as well as buying it outside of the workplace?
Well, I think disability insurance is one of the most overlooked types of insurance. I think if you are working, then you have a need for disability insurance. If you are financially independent, then you don't have a need for disability insurance. So think of it this way: is it's protecting your future income. So it's income that you're going to earn in the future. So if you don't work, let's say even if it's a short-term disability where maybe you're out for a year, you're recovering from a heart attack and you're out for a year. Let's say something happens to you and you can only work 80% of your regular hours. You're still facing a 20% reduction in income. And it's not only the reduction in income, but when you don't have that income, you don't have money to put inside for your retirement savings. So you're also impacting your long-term future financial independence. That's really the question that you should ask, in my mind, is, am I dependent upon my income? If you're financially independent or if your partner makes a lot of money and they won't need your income, well, then you don't need disability insurance. But for most of us, if we're still in our working years, we need our income. So you need disability insurance to replace that income. And it's just like, with our house. So if you take a look at your home, you buy homeowners insurance because, well, in California, it might cost you $1 million to buy another home. Most of us don't have a spare million sitting in our bank accounts ready to go if something happens to our home. So it's the same thing is, are you going to earn 2 million over the rest of your career? You have to think about that. Multiply your income by the number of years that you plan to work, and you'll be surprised at how large that number is. And if you have that much money in the bank, that's great. But most of us won't. So most of us do have that need for disability insurance.
Yeah, I do agree. It is definitely an often overlooked policy. And while, prices I think have definitely gone up for disability, would you say that locking in a disability policy younger rather than, maybe waiting until middle age is a wise move? How should people think about kind of getting the best possible price on a policy?
Well, it's always cheaper the younger you buy it. But the offset is that you pay premiums more years if you buy it younger. But if you're 22 years old, starting out in the workforce, and you're going to have to work for 40 years, you still have the same need for disability insurance because you're still going to be dependent upon your income. And when you look at the statistics, which are really boring and everything else, young people do get disabled. It does happen. Disability doesn't happen to people who are just 45 and up or whatever age you want to throw out there. Now, younger people may get disabled at a slightly lower rate, but it's still a possibility. And that's the whole point of insurance. You're insuring against potential risks. If you knew exactly when that risk was going to happen, you wouldn't be buying insurance. And home insurance, again, is a good example. If your home is on fire, no insurance company is going to write you insurance. And we all know that. We all know that an insurance company is going to say, oh, great, your house is on fire. Let me write you $1 million of insurance for $500 in premium. That's not the way it works. Insurance companies are in business to be profitable. And what they do is they do a risk assessment. They call it underwriting, but they take a look and they say, okay, basically like, okay, is this person risky? Are we going to make a profit off them? And you have to understand that with insurance companies, it's nothing personal. It's about the numbers to an insurance company, and they're taking a look and they're deciding like, okay, if we're giving this person $1 million of risk protection, whether it's life insurance, homeowners insurance, disability insurance, whatever, how much premium do we have to charge them so that we can make a profit? It's important for insurance companies to make a profit because, again, if we go back to disability insurance for somebody who's 22 years old and you get disabled at age 60 and you've paid in premiums for 40 years, you hope that insurance company is still around in 40 years to be able to pay the claim. And that's the thing, when you look at the insurance companies, financial stability is super important because you want to make sure that insurance company is going to be around a long time from now in order to pay your claim.
Let's talk about property insurance. We all know we need auto insurance. If we're a driver, we have to have at least the minimum coverage in our state. That's probably kind of what most people are well aware of in terms of property coverage. But homeowners, we have to have that if we have a mortgage. Our lender does not want us to own a property that is not insured. That is very risky for them. So that's why they require homeowners insurance. Talk to us a little bit, Tony, about what's actually covered in the homeowners insurance and what's not. I think a lot of people get very surprised after some unforeseen natural disaster happens and then, oops, something isn't covered that they thought would be covered, or only a small portion of that disaster is covered. What do we need to be aware of with our homeowners policies?
Well, the two big things that are not covered are floods and earthquake. In Florida, it's really expensive to buy flood insurance. So if you I know in California, so I'll use California as an example because I know the premiums because I'm paying them. We pay more for our earthquake insurance than we do for our homeowners insurance. And again, that goes back to what the insurance company is thinking about. The insurance company is thinking about like, okay, what happens if we have to pay out after an earthquake? It's going to cost them a fortune. So they have to price it accordingly. And flood insurance works the same way. And that's why it may not be covered, or it's not covered under the standard homeowners insurance policy, because it's really expensive. And what's happened with flood insurance and earthquake insurance is it's become so expensive to cover that with flood insurance, there's something called the National Flood Insurance Program. And that's where it's partially offset by the government. They help with offset the risk pool, so the insurance companies can afford to provide flood insurance. That's why it's expensive. So anybody who's purchased a flood insurance policy knows that it's really expensive compared to your homeowners, and that it's not even offered in some places. And that's why it's not part of the standard insurance policy, because if we go back to it, for an insurance company, if a house floods, that's pretty expensive. For the insurance company, they have to think about like, okay, how can we price this? And I think something that's also important is this is becoming much more common in Florida and California and other areas of the US. It's hard to get homeowners insurance sometimes. And that's what's happening is the insurance companies are saying, okay, well, if you're building your home, and again, I'm speaking a little bit more about California because I'm more familiar with the market, is if you're building your home in a place that's prone to wildfires, we're not going to write you insurance because that is too risky. So, and I think the same thing happens in Florida is people are building on areas. If you're looking at buying a house, you can ask for a flood map and it will show if you are in an area that's prone to flooding. And if you're in an area that's prone to flooding, guess what? The insurance companies have access to that same map and are going to say, well, you're in an area that's prone to flooding. We don't think that's a good idea. So we're not going to provide you insurance, or we're going to charge you a lot of money because it's a risk to us. And we think we're going to have to pay out money. And the one thing insurance companies don't like to do, forget about all the commercials, they don't like to pay claims. And so that's what they think about. Do we need to pay a claim or not? So I hope that helps a little bit.
Yeah. So with all of that, all of the increases that we've seen, as you mentioned in Florida, where I am, the rates of increase have been just phenomenal. I mean, it's just we've seen in some instances rates doubling and tripling. Buying a home that has a roof that is older than 10 years in some areas of Florida on the coast, you have to have a roof younger than 10 years old to even be insured. And so you can imagine the cost that that can add on a barrel tile Mediterranean style home. You're talking 40, 50, even $80,000 to replace a roof that's in great shape, but it just happens to be 10 plus years old. So anyway, it is a big challenge. So with all of that kind of going against us as consumers, what can we do to save money and just make sure we're paying as little as we can?